Let's take a quick look at Treasury yields moving lower after the latest economic data. PCE, Personal Consumption Expenditures data, was in line with estimates. Investors eagerly awaiting the Fed's next move on interest rates. Now, the CME Fed Watch tool showing 67% probability of a rate cut to come in September. For more on this, we're joined by Jennifer Lee, BMO Senior Economist and Managing Director here. And Jennifer, of course, we're beginning with this morning, just as we're thinking about what the market activity may look like as we round out the final trading session of the first half here, and what this really signals for the Fed in their own pathway going forward here. Does this move the dial?
Good morning, and thank you very much for having me on. I'm going to say that this report itself was probably the best that one can expect, and it certainly helps the Fed, I think, give them a little bit more comfort on their path to starting to ease policy, which we still expect to start happening in September. Obviously, you guys just went through the headlines, with a 0.5% increase in incomes and 0.2% in spending. But when you're drilling it down a little bit further, it was actually a little bit better, as I'm trying to say right now. Although that we were starting to see some softening on services spending. We've had 2 straight months of real spending of 0.1%, which is quite modest. And it's actually not a bad thing, because that's where all the stickiness of inflation has been coming in. So we start seeing some pullback or some cooling off in spending in the services side that will help cool the stickiness of or unstick the stickiness of inflation. So that, I think, was a good thing. But at the same time, consumers weren't pulling back completely. They're still spending on discretionary items like recreational goods and vehicles and recreational services. So it shows that not everyone is terribly worried just yet, but we are starting to see some pullback on things like dining out. So, so there's some paring back. Bottom line to all this, there's some paring back, cooling in services spending, which will help the services CPI eventually start moving downward. And I think this is all good news for the Fed, allowing them to exhale a little bit and again continue hopefully on that path for a rate cut to come in September.
Yeah, so Jennifer, okay, so that's what I was going to ask you there. The timing then of that rate cut here, do you think it's more likely that the Fed is going to act then in September?
Yes, I think so. I mean, obviously we had that strong or that very encouraging May CPI number. And as Fed Chair Powell said, it's a good number, but we need more of them. And, so over the next couple of months, we're going to start accumulating more inflationary data. This is probably one of the bigger pieces that we saw since that May CPI. And, we need to see all the different inflation indicators all pointing in the same direction. And that will give the Fed the comfort and the confidence it needs to start cutting rates in September.
But Jennifer, do you think it's more likely, though, that the Fed is going to err on the side of caution here? We talk about the risk here still to inflation, that we could see inflation rise just a bit. We talk time and time again about how this path forward for inflation is likely to be bumpy. Then wouldn't that, though, strengthen the argument that, hey, maybe it still makes sense, even though we have seen this progress, we are starting to see this disinflation, that it still makes sense maybe for the Fed to wait several months before cutting?
So we still have, a few more months before September rolls around. And for sure, I mean, if we had to, we're always asked, like right now we have officially 2 rate cuts for the Fed in September and December. And, we're always asked, if you had to lean which way would you be going? And we would sort of say that, with their err on the side of caution, as you just pointed out, and do fewer, I guess. But again, we still have a few more months of data to consume and to analyze. And, again, nothing goes down in a straight line. And the path to 2% is going to be bumpy, but as long as everything is pointing in that same general direction, I think it will at least pave the way for at least the first rate cut to come.
The Fed likes to look and continue to carry the fact that it should be apolitical. To what extent do you believe that factors into their thinking as well here, trying to dodge any kind of closeness or proximity to the general election?
It's tough, and this is like Fed's not alone. We've got the Bank of England, for example, like dealing with their next election coming up next week. So we've got, for example, that's where we had the Bank of England, sort of holding off until after the election, and among other reasons as well. So I think the Federal Reserve is very cautious on that front, trying to, as you say, dodge any bullets that could potentially coming from this election. But we do have them pausing in November just to see how things fall out before moving again in December.
All right, Jennifer Lee, BMO, a senior economist and managing director. Thanks so much.